Hey guys and girls, it's Nathan Birch here from B.Invested.com.au HQ. Today I'm here to answer some questions in from Facebook. If you've got any questions, you can forward them through facebook.com/beinvested.com.au. Question I've got today has been asked through: what consists of a crappy property portfolio? Well, that's a pretty broad range question that we've got there. The fact is that lots of different things contribute, whether it be poor foundations to your portfolio, whether it be having crap finance, having crap property managers that aren't getting the best rents, having poor accountants which have structured you up with all this crap you don't need or not enough, whether it be poor advisors, whether it be you listening to your friends and family, which is going to ultimately control the success of where you're trying to aim to go to, or whether you've got crap properties specifically in your portfolio. So I think I would just want to target on the crap property side of things, looking at what sort of properties would be shit in my opinion. So for me, off the plan stuff, don't like it. There's nice brochures and all that sort of stuff. Generally when someone sells something off the plan, there's a $40,000 to $50,000 sales commission in that for this marketing company to get paid for selling you that. So they make it look as best as they want for you to end up buying some crap. Buying over 55s and retirement living properties, it says it all. Like, you've got a marketplace of 100,000 people out there, for example. You've got a limited market, like 0.05% of the market, 0.5% of the market, which could potentially want to buy something like this. And do they actually buy it? It's a very minimal market. It's high risk and doesn't have much capital growth to it. And let's say, for instance, something goes wrong and there's no tenants in there, then you can't just rent it out to the rest of the market. It's limiting your market. So you want to have bread and butter properties in your portfolio. Having a portfolio of highly negative geared properties. If something's negative $10, $20, $30 a week, who cares? It's after all expenses I'm talking about. If you're buying a property that's purchased for $600,000, $700,000, it's renting for $400, $450 a week, that thing's going to be costing you like $300 a week out of your pocket. It's 15 grand a year. If you have two of them, that's 30 grand a year out of pocket. Take your tax deduction, shut up your ass, because it doesn't mean anything, because you can only get stuck at 2 properties and not get 10, 20, 30, 40 properties. You need to hold a property portfolio that's going to take you through a market cycle, and that's what's important. So those things will hurt your growth. Other things that come in is student accommodation, holiday accommodation. Those things there all carry the same risk, much as the over 55s and retirement living that I was talking about. So very important, you want to make sure you're getting bread and butter properties. They've got a good rental return, got good upside for growth, readily available for tenants, good cash flow, below market value, upside for growth. That's what makes good properties in your portfolio. Lots of shit stuff out there, as I mentioned on, and I'd be staying clear of all those market segments unless you're going to give me one for free. And when I say give me one for free, 10 grand, 20 grand, that would be the maximum I'd ever pay for one of those sorts of properties, and it better be fucking good for me to have to pay 10, 20 grand for one of those ones. We'll catch up soon, guys. Have an awesome day. If you've got questions, send them through facebook.com/beinvested.com.au.